Look, how would you sum up this market at the moment? I guess a good place to start might be looking at those yields in the US because they're kind of driving the volatility at the moment.
Yeah, to me, that's where it all starts. Some people are like, oh, I only trade stocks. I don't really care about bonds. And it's like, well, as an investor, if you have any sort of exposure in the stock market or in any market for that matter, the bond market matters to you because the biggest institutions in the world, they have to play in the big boy sandbox. They can't be messing around with cryptos and micro caps. They're in the big boy sandbox, and that's the bond market. So whatever's going on in the bond market is just going to trickle into everywhere else. So, interest rates could be going up, interest rates could be going down. But if they're doing either one of those faster than most people would like, then it's going to trickle into other areas and you're going to see volatility expand elsewhere. And that's what we're seeing. We've seen it before. It's not anything new, but that's what we're seeing now.
Yeah, so looking at that chart there, JC, are we seeing a replication of those smiles, do you think? And volatility is likely just to increase and those bond yields to push higher?
It certainly appears that the path of least resistance for bond yields is higher, not just domestically, but around the world. And I'm going to let the market prove that thesis to be incorrect. Right now, I think we have to give the benefit of the doubt to the bond bears as interest rates are going higher, particularly if the U.S. 10-year yield is above 10%. If U.S. 10s are above, above U.S. 10-year yields are above 1.4%, if that's the case, there's just absolutely no bullish, there's no argument to be made to be bullish bonds. You got to be betting on the types of stocks that are going to benefit from higher yields, particularly energy and financials are two that really stand out that benefit from higher yields.